Hello and good afternoon. Welcome back to another Fit Finance session. We are another musketeer down this week again. It's just myself, Tim Webb, and my colleague and good friend Tom Senogles. Henry is off somewhere, telling himself once again. So this week we've got a couple of topics for you. One of the most pertinent questions we get asked is, should I invest in property, or how much money should I invest in property versus that of a more diversified portfolio or the stock market in general. So I think we're going to kick things off on that sort of topic. I think Tom's got something to share on that vein. So Tom.
Yes, like you said, we often get asked that, and reality is you should get more return for investing in a property because you're taking more risk, you're putting all your eggs in one basket. But there's been an interesting article from Schroders this week, and obviously we invest clients in the markets and have been doing so for many years. But I think there's a lot of misconceptions around return and the various bits and pieces. So Schroders put out an article this week. The data is based on the Bank of England's data, so impartial to Schroders, even though Schroders is an investment house. And effectively, if you took £100,000 worth of UK property 25 years ago, it'd be worth on average £416,000 today. Even if you're in the London market, it would be worth £648,000. Or unfortunately, if you're in Yorkshire, it's much nicer than probably being in a dirty flat in London. Then that'd be £356,000. If you invested in the global stock market, however, that value would be, so that same £100,000 would be £787,000. So that's 22% more return than even if you invested in the best performing market, London, obviously, over the last few years. And it's not just if you look through that 25-year timescale, it's the same if you look over 5, 10, 15, 20, 25 or 30-year time horizon. So the market can deliver better returns than property. It's the difference is if you're in a diversified portfolio, you also get slightly less return, but you also get less of the volatility, and that's understanding risk versus return. And I think the key premium that people forget is liquidity. If your assets are all tied up in a property, then you can't get access to them. So it's a case of you can have your cake and eat it too. You can have more return and still have access to your money. And I think as well, if you start factoring in the tax these days, if you're able to get that return within an ISA or even unwrapped investments, you're paying very low rates of capital gains tax. I know we talked about potential reviews to capital gains tax recently, but when you start looking at net returns, the figures are even better. So common misconception that the stock market doesn't perform as well as property. All assets are good. You're holding real assets. They're going to provide growth in excess of inflation over a long enough cycle. But some really interesting data to kind of back up what is often pub chat or hearsay chat about which one is better.
Yeah, definitely. I don't know about you, but almost ironically, a lot of people that I come across who are actually, to their own admission, actually through our analysis, are quite risk averse. They tend to just particularly want to drive towards property, whereas I always say to them, actually, looking at it at a top level as a concept, there's not too much difference from what you're doing with property, i.e. most people buy it on obviously the mortgage, and property as an asset class is one asset class. So you're taking a lump of money, going to the bank, getting as much borrowing on that as possible, and then dumping it all into one asset class. Not to mention the other liquidity issues and tax issues that you've raised as well. So on that basis then, and I say to people, shall we go down the bank and get as much as we can on your capital and then chuck it all in the stock market? Suddenly gets a different reaction. Whereas conceptually, that is what you're doing, just in a different medium. I'm completely against property or anything like that. It's just opening people's eyes, I think, to, as you say, the common misconception that it's the easiest thing to sort of think about and chuck your money into.
Yeah, and it comes back to diversification. If you've got a core portfolio which is liquid, you can get access to it, then by all means go buy property, and we can help advise you how best to go do that, whether to do that personally in a limited company, whatever it might be. and we can help via Dan, our mortgage expert, to obtain that leverage. But it's all about having tools and options. You don't want to tie yourself to the mast too much, but also you can get better returns. And lots of people will say, well, should I pay off my mortgage? It all depends on how much risk you want to take. I don't think, but like in your example, no one's saying run a 90% mortgage, interest only, and put all your money in the market. I think it's finding a balance which is comfortable. But equally, if you've got a 200 grand mortgage and you've got 200 grand in the market, yes, it might move up and down, but it's unlikely that you need to repay your mortgage instantly in a short period of time. But you could probably have some liquidity, gain a better return than what the interest that you pay in the bank, and still prosper in the market. So yeah, I think that particularly new investors, that's often asked. Having both is good, but I think having a core portfolio and having liquidity and access to your money is, particularly in this day and age, with people don't know what's going on with jobs or anything, then yeah, having your assets tied up is another price to pay at the same time. But moving on from that topic, I mean, if you've got any questions on that or anything in particular, then come and speak to us. And every instant is different. So either comment below or come and have a chat with us. But I think, Tim, you've been reading some articles about what's going on, Trump and China, and that never-ending saga, it seems.
Yeah, no, any of our listeners will be bored to hear me mention it again. But yeah, over the weekend, anyone who's keeping up to date with it. So on Saturday, the US and China were scheduled to meet to discuss the progress, I suppose, or the status, if you like, of the phase one trade deal, which was meant to have been done also December, beginning of this year. But it's actually been postponed for whatever reason. I haven't come across a firm reason, but nevertheless, it has been postponed, which obviously isn't a good indicator of the health of the relations, potentially. I have seen some chat about it being perhaps, now that we're closer to the ever-closing November, the election time for Mr. Trump, whether or not he's sort of gearing up for more of his protectionism type approach, sort of potentially to ramp up more votes. But who will know? In terms of relation to the market, actually the market hasn't really had too much of an issue with it. The FTSE was sitting at the same sort of level that it has been for a good few weeks now, if not months, sort of around the 5,100 level. I know I've got some more information a little bit later on the market more generally and globally, but actually it seems to have been fairly well received. But I suppose actually it's sort of more of the same rather than an outcome, whether it be good or bad. It's a sort of TBC.
I think it's going to rumble on for a while. I think I think in some ways the Chinese will probably know that they'll have leverage over Trump in any negotiation because of the election, and he'll want a win prior to the election, and therefore almost better to not lose than to
risk.
Yeah, risk ahead of an election, particularly when there's a lot of talk around how well he's dealt with the crisis. And I think Biden's doing very well over there in terms of gaining momentum, but I know that the core base of Trump is very strong. I think as much as lots of people are predicting a Biden win, I think it's still very much 50-50. I think no one predicted him winning in the first place. So, and I think it's very hard to move those voters from where they are now. You've got to change people's opinion. So, they're quite hardline voters. There's always people in the middle, but it'll be interesting to see what happens. But
well, obviously he's in addition to that, he's banned the use of TikTok, hasn't he, in the US, which China definitely wasn't happy about. In the fear that it was linked to the Chinese intelligence services and that sort of thing. So, there's clearly irons in the fire. It's just knowing, or not knowing, clearly how they're going to come out. But it's
and I think you'll see more of that. You'll see more of sort of optical things like TikTok, where they can create a story without having to really do much, because that will help his campaign rather than actually trying to do a deal, despite being the art of the deal is his so-called forte. I think you'll just see lots of more rhetoric from both sides rather than any sort of significant movements. And I think therefore on a global macro scale, that's probably less of an issue. I think it's fairly factored in. It's weighing on valuations, but I think unless we start seeing significant second wave, then I think markets will continue to tick up. But I think it's interesting you mentioned the FTSE being at the 6-1 level or there and thereabouts. There's an article in the FT sort of explaining the US markets. I think Korea and China have pretty much recovered most of those losses, whereas a lot of the European markets are still down considerably. That does offer some opportunity. I think there's probably a good barometer of what the rest of the economy is doing, because those markets that have seen a lot of recovery is because of the high tech element. Whereas if you look at the UK or Europe, there's very little tech exposure. So it's there's definitely different cycles going on at the moment. So it's interesting, but again, if you're diversified, there's nothing really to worry about. I think a lot of clients' portfolios have been down, come back up, and are either level or slightly under. And given the economy outside, that's a pretty good scenario to be in. And then hopefully, once things start to progress, then they'll keep pushing on from there. So a good sort of place to sort of either enter the market or build the portfolio from then on.
Yeah, for sure. I mean, obviously we've got one more quarter left of the year, but if we could come out even level-headed from where we started in the year to maybe a little bit of growth at the end, given what's gone on in society and in the world this year, I don't think that's too bad. You could ask of your investments, really. Of course, other people would disagree with that. Some people will think that should be carrying on, but yeah.
Yeah, it's a bit of a lopsided economy at the moment. I think if you look at earnings from some of the FTSE companies, some of them have had some really good returns following the results. I think Rightmove was up 8% in a day, something like that. Next has held up really well considering it's a retailer, but others have faltered. So there's definitely winners and losers out there. Just got to stay diversified and have some good active management at the same time. I think indexing has its place by all means, but as long as you can deal with the pros and cons of different approaches. But that's what we're here to explain. There's no right or wrong way. It's just finding out what's best and what's most comfortable for you, really, at the end of the day.
Yeah, exactly. Very subjective.
Yeah.
It's an art. It's an art. It's not science. I normally tell people, much to the contrary.
Despite all the data.
Yeah, exactly.
I think that's it from us for this week. But yeah, as always, please comment on what we're saying. If you disagree with us, then we'll be more than happy to discuss why you're wrong. No, I think there's no right or wrong, but yeah, some interaction or comments there, that they're always welcome. So yeah, thanks for listening, and yeah, tune in next time.
Take care.